In part one of chapter 6, we learn how to close out what's known as the temporary accounts. An account is the one that only shows information for the current accounting period and is going to be given a zero balance at the end of each accounting period. We identify the revenue accounts, the expenses, and the drawing account has all been temporary. We know that the income summary account is used during the closing entry process to close out our revenue accounts and our expense accounts. So we identified REID, R-E-I-D, as the four steps of the closing entry process, closing out the revenue accounts to income summary, close out the expense accounts to income summary, close out income summary to your capital account, and then close out the drawing account to the owner's capital account. So we went through all these different steps in part one of our video lecture. We now want to go through the posting process of posting the closing entries to the appropriate ledger account. So every journal entry we just saw, each account involved in the closing entry process has to be posted to the appropriate ledger account. We write the word closing in the description column of each of those ledger accounts to identify the type of transactions we are about to post into the ledgers. Once you're done with the posting, the ending balance for any account that's temporary, drawing accounts, revenue accounts, expenses should all have a zero balance. For example, here is the fees income ledger account. This is part of the closing entry from the general journal. We now want to post this closing entry into our fees income ledger account. Remember the 5 steps of the posting process. So first, we record the date of the transaction into the date column of the ledger account. Step 1.5, we write the word closing in the description column of our fees income ledger account. Next, your post reference is the journal page number. This says page 4. So we put in J4 as our post reference to identify where the information is coming from. Whatever took place in the journal, recorded on the same side of the ledger account. So fees income in the journal, we debited for $47,000. We record $47,000 on the debit side of the fees income ledger account. After you post each transaction, determine the account's new ending balance. Fees income will now have a zero balance after we post this transaction. And that's what you want. If an account is temporary, it will show a zero balance in the ledger account after you posted the closing entry. Now that the amount has been posted, go back to your journal, write the account number 401 in the journal post reference column. That's indicating that this transaction here has now been posted into your fees income ledger account. Next, we have the income summary ledger account. We're going to post each income summary transaction into the income summary ledger, going through the same 5 steps of the posting process. So first, we create the account for $47,000. Well, we got the date. You write the term closing. J4 would be your post reference. The credit for $47,000. The balance would be $47,000. Recall from the journal entry, I'll go back for a second. That was just this one transaction. You also post this transaction here and this one as well into the income summary ledger account. And once you posted all of those transactions, they're not on my slideshow, but once they're all posted, you would be showing a zero balance in your income summary ledger account. Next, we prepare what's known as a post-closing trial balance. Notice that we're almost at the end of the accounting cycle when you prepare a post-closing trial balance. This is a trial balance prepared after the closing entry process to make sure the debit ending balances still equal the credit ending balances. Now remember that at this point, any account that is temporary has now been closed out. Therefore, you only have permanent accounts listed on your post-closing trial balance. Perhaps you're saying, well, what types of accounts are permanent? The permanent accounts are your assets, your liabilities, and the owner's capital account. Because again, any account that is temporary, which are your revenue expenses and drawing account, they have a zero balance at this point. The amount from these have been transferred over to the owner's capital account to determine the owner's ending capital balance. So let's take a look at a post-closing trial balance. So we have our heading, the who, the what, and the when, the name of the company, the type of statement, and the time period. So again, this is an internal statement. It's not seen by those outside of the company. The trial balance is as of a specific date. These are showing the account balances on December 31st of 2019. First, you list your asset accounts, followed by your liability account, and last, you have the owner's capital account. Because again, your revenue accounts, expense and drawing accounts, they each have a zero balance. Their balance has been transferred over to the owner's capital account. So the capital balance here, this is your ending capital balance after the closing entry process. So once you post all the closing entries, this is the balance shown in the owner's capital account that we use on our post-closing trial balance. The purpose is to prove the equality of our debit and our credit ending balances. If done correctly, the total of the debit column will equal the total of the credit column. So we prepared this to say that, okay, we're now in balance. We can now close out this current accounting period to prepare for the upcoming accounting period. So once again, only permanent accounts are listed on the post-closing trial balance. Any account that is temporary now has a zero balance after we complete the closing entry process. Okay? So if your post-closing trial balance does not balance, it means a few things. There could be an error in your accounting records, and you'll use your audit trail to go back through that. So look through your journals to make sure that every amount was posted correctly. Check your debit transaction, your credit transaction, make sure the amounts are on the correct side. Also make sure the amount was not transposed, meaning that the amount should have been $450, but we record it as being $540. So go through those steps to make sure that everything is done correctly. Last but not least, interpret the financial statements, meaning that can I use these statements to make decisions about a company? Do I understand the information that is shown on these different types of financial statements? These statements are used to help users make all kinds of decisions. For example, we may have questions on what is our cash balance, how much money do our customers owe us, how much we owe our suppliers, did we make a profit or did we make a loss over a specified time period? So in order to answer these questions, we are going to interpret the information that is shown on the financial statements. Okay? So for example, if there's a question about the cash account, go to the balance sheet. The balance sheet shows our cash balance as of a specific date. How much money do our customers owe us? Go to the account receivable account. The account receivable account represents the amount of money that is still owed to the actual company. Questions on how much do we owe our suppliers? Go to accounts payable. The accounts payable account shows the current amount that is still owed to our suppliers and or our creditors. Did I make a profit or a loss? Well, the income statement will show us our net income or the net loss as of a specific time period. So what we're saying is that we can utilize these statements to answer questions about the finances of any business organization. Okay? So that will conclude our lecture over Chapter 6. Be sure to review all of the other Chapter 6 lecture information.